So on one hand, we're getting comments around the debt ceiling from Kevin McCarthy that says, do you have an extra $800 lying around? That's how much more you owe as your share of the national debt since January 12th, when I first called on President Biden to negotiate. His delay has real consequences. His default would be even worse. And then you get headlines like this. Debt ceiling negotiators close to a deal with IRS funding and spotlight. What's going on here? Are we close? Are we not? Are we going to default? I mean, there's a lot of questions that are here, and a lot of people expect that we will get an outline of a deal here very shortly. So I think that's going to be really what is a main focus of this market in the next upcoming week. Now, like I said in the last video, if you get a debt ceiling deal, it might not be, hugely positive just based off of spending cuts. Now, you're getting a headline coming across right now that I'm looking at. It says, McCarthy says they have not spoken to Biden in the last 24 hours. We will work until we get it done, he is saying right now. So kind of some weird comments. Weird comments coming out, guys. So this situation could go either way. But what we know right now, especially with AMC stock, collateral has not gotten squeezed yet. That's a fact. You're still waiting to see big tech come down, whether it comes down due to the debt ceiling or potentially a credit downgrade. It will happen eventually. Now, where we currently sit with AMC stock still looks very good, and that's what I want to get into here in this video, as well as outline the data and kind of what has happened in the day today. So let's get into all of that information. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. So like I said, number one, it's the debt ceiling situation. You'll probably get something over the weekend. You'll probably get some kind of deal, just depending on, what is cut from where. It could affect the markets, because a big reason why the markets have done well, I've said this before, is things like the Inflation Reduction Act that spent trillions of dollars. That's kind of what has helped keep this market up. Now, I talked about this in the last video as well, but one of the biggest things as well after the debt ceiling is raised is, what does the Treasury do? The Treasury TGA is the Treasury General Account. And that is really coming down to nothing. It's sitting at about $49 billion here today. And they're going to have to refill that. And the interest rate's going to be very high on that. But number one, it's going to pull out a lot of money from the system, right? When they do raise, trillions of dollars in treasuries, it's going to pull that same amount of money that would have otherwise went into equities or went into something else. It's going to go into the Treasury General account. Now, if a deal were not to get done this weekend, then it looks like you would probably get a default. Like, this weekend is coming down to the wire. If they don't pass some kind of extension or deal, markets are really going to freak out coming on Tuesday. Next Tuesday is going to be May 30th. And it takes time to get these deals passed through Congress. So it's not like an instantaneous process where you have a deal and instantly the debt ceiling is raised. No, it does take some time to get these things done. So I think that's a big problem. Now, the credit rating downgrade, I think that is ultimately coming. And I think that is really a thing that is not really regarded in the markets right now as a possibility. Even though Fitch warned us of a downgrade, even if we avoided a default and got a debt ceiling extension, they warned us of a downgrade back March 6th of 2023. So almost 3 months ago now. and they just put the US credit rating on negative watch, which means there's basically a 50-50 shot or chance that we do get defaulted or do get downgraded on over the next couple of months. Now, what happened last time around on August 5th, 2011, you got downgraded on a Friday, which wouldn't that be coincidental if you got downgraded again on a Friday? It would likely be in after hours, though, because they just don't like to do that during regular trading. They like to give you the weekend to kind of digest this downgrade. Last time around, markets fell 6.5% when S&P Global downgraded the market. So I think that is actually a decent probability of happening this weekend. Now, if that does happen, that would cause stocks to fall. That would put pressure on a lot of your large tech stocks, but also, your small and mid cap stocks have already crashed. They've already fallen. So with that kind of mindset and that thinking here, maybe you could see big tech fall and carry the way down, and some of your small and mid cap stocks might actually perform decent because they've already crashed. If you guys take a look at the breadth of this market, it's terrible. It is absolutely a nightmare. The NASDAQ keeps going higher and the average stock keeps dropping. Like, stocks have already crashed. Like, that's a fact here. And the NASDAQ up another, what's it look like? Another 1.5% today so far. So very, very strong day. Now let's talk about the data that came out earlier in the day today as well. Go ahead and pull up the economic calendar. I highly recommend you guys use this tool. If you have not before, you'll get all of the numbers when they come out. So you had durable goods orders month over month for April. You were expecting a negative 1.1%. This came in at positive 1.1%. So better economic data for the economy. Core PCE price index month over month came in at 0.4%. The estimate was 0.3%. So this did go higher from last month's reading of 0.3%. Now again to 0.4%. Very bad inflation numbers right there. Now, personal spending month over month for April came in at 0.8%. You were expecting 0.3%. Last month's reading was 0.1%. So personal spending also ramping up, negative for inflation. Personal income, expected to see that at 0.3%. It came in at 0.4%. Again, bad for inflation. Now, if you look at PCE price index month over month, the headline, you were expecting 0.2%. That came in at 0.4%. Last month's reading was 0.1%. You are seeing massive jumps to inflation here that if you looked at the markets today, you wouldn't notice that as being a bearish thing. It's not having a bearish effect on the markets, but it's a problem. And the Fed, I think, is going to tell us it's a problem here the next chance they get. Now, for PCE year over year, that came in at 4.4%. You were expecting 4.1%. So again, bad inflation data. And this is really the story over and over again. It's bad data, just bad for, a pause in rates. The Fed's not going to pause rates. That's insane. That's not going to happen. You're going to get another hike, and if the data is strong through June and July, you'll get another hike in July. And markets are finally starting to at least price that in. Now, Michigan consumer sentiment. This is really, if you want it to be bullish on today, it's the Michigan consumer sentiment survey. The final estimate for the May survey came in at 59.2. Forecast 57.7. So overall, a better consumer sentiment number. The inflation expectations, the 1-year inflation expectations, down to 4.2% from a previous 4.5%. The forecast was for this to remain at 4.5%. Michigan consumer expectations came in at 55.4. The last reading we got was 53.4, so again, positive for the economy. Michigan current conditions came in at 64.9. You were expecting 64.5, so positive as well. And the 5-year inflation expectations, you were expecting that at 3.2%. It came in at 3.1%. So basically across the board, the Michigan Consumer Sentiment Survey, the revisions that you are getting are positive. They're just positive. So if that's not, if there's something to be bullish on today, it's not inflation data. It's the Michigan Consumer Sentiment Survey. And after that did come out, you did see the markets start to rally after that because, it was a positive thing. Now, if you look at the Fed Rate Monitor tool, you will see that markets are now pricing in a rate hike in June. They're very volatile. They are going back and forth. But right now, there's a 55% chance of a rate hike in June, a 45% chance of a pause. So the next data points around inflation, around economic activity, earnings and so on are going to be important for this market. They're going to push around these odds of a rate hike or a pause. Now, what's interesting is even if we get a pause in June, markets are fully pricing in a rate hike in July. So it would be like a short-lived pause in June if that does happen. 50.8% chance of getting a rate hike in July. Now, what's interesting is there is a 23.2% chance of getting a rate hike in June and a rate hike in July. So there's definitely some bearishness as far as, the Fed policy going ahead. By some investors out there in the marketplace. It's obviously not reflected in large tech at all, but it is there, guys. Okay, so that's really what we're contending with today. A possible downgrade could come at any time of U.S. credit. That's what I'm watching for specifically over this weekend. I think if it's going to happen, it's probably going to happen this weekend. Wouldn't surprise me if it happens right after the bell today. So be on the lookout for that if that news does come out. And I'll keep you guys updated on if it comes out. So enjoy your weekends. Just make sure you guys watch these videos and hit that like button to stay up to date with all of this information. So we're going to go ahead and switch back to AMC stock and look first at the Stonko tracker data because you've really seen a lack of option activity populating over the next 2 option expirations. So the next 2 option expirations might be pretty small, right? What we're seeing right now is 2,300 calls in the money for June 2nd, 55,000 calls out the money, 20,000 puts in the money, and 22,000 puts out the money. Now, GME will be reporting earnings here very shortly, and I think that is the next big catalyst that could push AMC stock up higher, minus any news that we do get from the courts, right? The courts are really is what is going to drive AMC stock. That 20, 30, 40% move, it's going to be based off of that. Now, with the low option activity heading into these next 2 weeks, if you do see some short-term, traders coming in and buying some of these options, buying some of these calls, or maybe selling some of these puts, that could also give you a boost to the upside. I'm not going to sit here and say we're looking at a gamma squeeze because we're not right now, but that could definitely help AMC stock. Now, June 16th, that's going to be the next big option expiration for AMC. You're looking at 4,300 calls currently in the money, 453,000 calls that are out of the money. There's a lot of potential buying power sitting right here, ready to be hedged for by the market makers if AMC stock does rally. Puts, you got about 340,000 puts in the money, 486,000 puts that are out of the money. If you do go ahead and take a look at AMC and the option activity for June 16th, you have a lot of this option activity that is really concentrated close to where we are right now. At the $5 strike, 66,000 for open interest. That controls 660,000 shares market makers would have to go out and buy. If you consider AMC's volume is anywhere from 10 to 15 million shares on any given day right now, I mean, that's sizable. That's very sizable. At the 550 strike, you're looking at 33,000 for open interest. At the $6 strike, 37,000 for open interest. At the $7 strike, 29,000 for open interest. So you kind of get the idea here. There is a lot of option activity that could lead to somewhat of a gamma squeeze leading into June 16th. Now, it's also possible, like I said, if you get short-term traders that come in for even next week, that could also help give you a gamma squeeze as well. At the $5 strike, you have 16,000 for open interest. At the 550 strike, you have 14,000 for open interest. Then you drop to 8,000, 4,000, 4,300, 1,300, 3,300. Still sizable numbers, especially if you do get more options heading into some of these strikes. If AMC does catch a rally in the week ahead, that could, drive a lot of buying pressure from market makers. So I'm not ruling it out. I'm not going to sit here and say it's the most likely scenario, but it is definitely a possibility, especially if you do get some negative news for the markets, maybe a downgrade, maybe lack of progress on debt ceiling talks or something else. There's a lot of things that could happen. But if you get something to push down big tech, it's going to put a lot of pressure on hedge funds and institutions that are short in some of your small and mid cap stocks like AMC. It doesn't necessarily have to be AMC, but when you start to get some downside in the markets on an index level, it's going to be from your big tech players. Your small and mid cap stocks, they don't drive the markets. They've already crashed. Your small and mid cap stocks have already crashed. They're just obliterated. Okay? So it's really just a couple names that are holding up this market right now that happen to have all of the collateral that is pledged against AMC short positions. So it's a waiting game at this point. Now, as far as the Ortex data, what we're currently seeing a 90 short score for AMC, $511.27 million worth of short positions on AMC, 21.07% short interest of free float. Free float out on loan, 33.9%. I find this interesting. As the short interest apparently fell 5%, the free float out on loan has been going higher in the same time period from 31% to 34%. That doesn't make too much sense at all. So we'll see if those numbers correct themselves or if the short interest goes higher. It's very weird. I don't know what is happening there. 175 million shares that are out on loan. Days to cover 6.11. Cost to borrow 56% and 100% share utilization. That cost to borrow, the days to cover at 6.11 is really getting me bullish. If that continues to go higher, that's going to be super positive for AMC. Now, cost to borrow fees for the day, 63.77. Cost to borrow max, 109%. Cost to borrow minimum at 47%. Interactive brokers, 450,000 shares currently available with a cost to borrow fee of 51%. These numbers are very high still, right? They are super high. And even though they're not 1,000% anymore, this puts a lot of pressure on shorts. And I want to make sure you guys fully understand that. These cost to borrow fees are, I mean, if you look at the cost of borrow fees from the start of 2023, they are crushing any possible thesis of this arbitrage trade. It's like literally gone at this point. You have lost all of your potential gains you were going to make from that. And I think maybe that's why shorts did cover. If they did cover, if this data is real, shorts covered 5% of the free float. Again, that's a very bullish thing. Very bullish thing, guys. So that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.